Okay, today we are going to talk about leverage, specifically leveraging money to fund a whole life insurance policy, or even perhaps the concept of an IUL. Does it make sense? Because this concept has been around for a long time, especially when you look at premium financing. We're going to look at an example of that towards the end of this video. But the whole concept of leveraging other people's money to fund a cash value life insurance policy has been around for a while through premium financing. However, today it's offered to many more people. So what I mean when I say that is typically when you look at premium financing, we need to qualify for that. We need a minimum of a $5 million net worth as an individual, or we need to own a corporation. If it's for business planning, premium financing may be a fit. Now, this topic of leveraging money to fund a high cash value life insurance policy, many insurance companies and lenders have opened it up to call it the masses, where it is much easier to obtain a loan from a lender that says, hey, I'm going to give you money every single year for a period of 5 years, 10 years, perhaps 20 years. You're liable to cover the interest or have collateral to satisfy that loan. But really the sales pitch is, if you put money into this policy, you can cover the interest expense only, and the policy performance should outweigh the interest earned on the loan. Now that sounds great. The question is, does it actually work? Like when we talk about high cash value life insurance and what companies to select, how to design a policy for maximum cash value, there's certain companies in which we have obtained proof of actual performance of certain companies delivering among the strongest cash values, where others have not disclosed proof. My point here is I want the proof before we look at any strategy. I don't want to purchase a product or take out a large amount of debt via loans on something that might work or hypothetically should hit a home run, but if it doesn't, now all of a sudden I've got buyer's remorse. I'm like, oh, why'd I do that? So how it works, this strategy of leverage, to simplify, is typically I will obtain a loan at, call it 3%. Maybe I'm financing $100,000 per year to feed a life insurance policy. 3%, typically I'm liable to cover the interest only. Some institutions and insurance companies will state you do not have to cover the interest only. The compounding within the cash value life insurance policy can cover that for you. But if that's the case, I have to have some type of collateral to cover the loan balance and the loan interest if it's adding to the loan balance. There's gotta be something there to protect the lender since they're giving us that money. It's not free money. Now the sales pitch is typically this: I borrow from an institution to fund a policy, and that life insurance policy should produce between 4 and 5% if it's a whole life insurance product, and between 6 and 7% if it's an IUL product. So that is really the stopping point, in my opinion. When I see or hear that, I've got to have proof there. And if I'm a consumer, that's the thing I should be asking for. The reason why is we've done several historical studies, and if you've watched any of our videos, you've heard me talk about this. Certain companies have delivered among the strongest cash value internal rates of return to policyholders. Those companies are MassMutual, Guardian, New York Life, and Northwestern Mutual. How should I rephrase it? They've disclosed proof of performance. And I'm talking about actual policy performance, not just projections or illustrations that assume I should have a certain amount of cash value at the end of the day. Now, an IUL can potentially hit a home run for me, but the question is again, is there proof? Proof of concept, proof of performance, which we don't see it there. So whenever I'm looking at a strategy where I should leverage money to feed a high cash value life insurance policy, really what my encouragement would be to do is look at the guarantees. We almost want to copy what a premium finance situation would require of us, which the insurance carrier is going to look at the guarantees, and the underwriting and case review is extremely thorough. We're going to look at that in a minute here too. But typically, how this strategy or process works is I am going to use the cash value to pay off the loan at a later date. So, for example, if I'm borrowing $100,000 per year for a period of 10 years at 3%, Year one, $3,000. Year two, that'd be $6,000 because I'm covering the loan interest out of pocket. And then, of course, the loan balance is compounding, so the interest on the total balance will be larger, of course. And it'll continue to grow over time. Now, again, this pitch is that cash value will accrue, and eventually you can use the cash value to clear the loan altogether. Or option two, if the lender is comfortable holding on or having a loan outstanding for a long period of time, the death benefit can eventually satisfy the loan. Now, collateral will be required in this situation. So if I look at any type of life insurance product, if I pay in $10,000 per year or $100,000 per year, will I have full cash value? Will I be cash on cash in day one? No, I will not. So if I take a $100,000 loan from a lender and my cash value is $85,000 right off the bat, 85% call it, that means I need to have in collateral an additional $15,000. In the event I default on the loan, something goes south, the lender wants to see that so they are protected. They're leveraging, or we're leveraging, they're lending us the money. Now, let's continue on. How this strategy works, to kind of recap everything here, is I'm going to borrow X amount of dollars. I'm going to fund a policy with that money. The money I borrow, I'm borrowing at 3%, and I'm hoping that the policy will produce, call it between 5 to 7%. That's typically what we see out there. That gives me a nice positive spread because I can leverage in the low interest rate environment to then feed a high cash value life insurance policy. The thing I want to be aware of, I'm not saying that we don't want to do it, but it's all hypothetical. Right? We've got to know this information up front, really setting expectations properly, seeing what happens if it works very well, and seeing what happens if it does not work that well. This way we don't get caught in a situation where we're like, oh shoot, I put all this money in or I borrowed all this money and now I've got to find a way to pay it back and my policy can barely cover it. This topic, illustrated versus actual performance, right? Where we often see policies project strong cash values. And as a consumer, it's fair to say, hey, I see this on a projection, I'm assuming that it's going to happen. But then if it doesn't, right, if I'm seeing illustrated results of $1 million and then the actual value produces $650,000, I'm disappointed because I received much less in cash value than what was originally anticipated. Now, if I see the different assumptions up front, if we look at a policy and say, okay, the projections typically look very good. If I look at a span of the past 30 years, for the most part, dividends have gradually come down. Meaning if I purchased a policy in, say it was 1980, if I want to go 40 years back, I lived through the 80s and had double-digit dividend rates. Now, since then, dividends have come down. So an illustration in 1988, that's when I was born, looked phenomenal relative to how it looks today. Point being, numbers projected great on the illustration, the actual performance was much less. We've talked about this point several times. When it comes to actual performance, typically with our 4 major mutual companies, called the Big Four, why I'm so big on these guys is not because of their size, their safety ratings, their financials, none of that, simply because we've seen them consistently deliver and disclose proof of performance. Mass Guardian, New York Life, and Northwestern Mutual. The thing is, we can't even use Northwestern Mutual just because of how their setup works as a company, but solid company in terms of actually producing strong cash values and long-term death benefits to their consumers. So I'm always interested in what is the net internal rate of return on an actual policy, not a hypothetical, not an illustration. So we mentioned earlier that this strategy of leverage closely imitates that of premium financing. So we're going to look at an example of premium financing here in a second. Let's go through the details first. So when it comes to premium financing, typically this is suited and meant for high net worth individuals. Typically, I need a minimum of $5 million in net worth to even qualify for premium financing, or it can be used for business purposes. The underwriting and case review is extremely thorough when it comes to premium financing. A company is not going to be quick to issue this. Nope, it's going to be extremely thorough. They're going to want tax returns, P&L in a lot of cases. The underwriting is like it normally is. Let's make sure the individual is healthy, but this is a much more thorough case with a traditional premium financing, not the leverage we were just talking about that is available to most individuals, but very thorough here. The company, so specifically what I mean here, the insurance company does prefer the interest to be paid out of pocket. What I'll add here is a lot of times when we request a premium financing proposal, it has to be approved by a home office with the larger mutual carriers. They are extremely conservative when it comes to premium financing. They've stated many times and still state this. We just looked at a case actually where they want the policyholder covering the interest out of pocket. Meaning you can develop a model where I borrow money, I go to an institution, they finance my premium, but the cash value can cover the loan interest. Or another way to put it is the loan can actually compound over time. I can just have the interest roll over in the balance. I have to have some form of collateral to satisfy that loan, but some companies and lenders approve that, or I should say more used to, not so much anymore. You'll find most insurance companies prefer that the interest is covered by the policyholder. The guaranteed values are reviewed, I should state carefully reviewed here and considered. Now here's some advantages to it. Minimum out of pocket initially, and it provides a high death benefit at a very low entry cost. Keyword is entry cost. You'll see why in a second here. So if I am a corporation, it's common to see the average premium financing case is $500,000 per year, right? So if that's a 10-year fund, $500,000 per year is $5 million of lending over that 10-year period. So if I'm a company and I need or want my cash flow to go toward my business, not towards a cash value life insurance policy, what some businesses will do is say, all right, well, let me borrow the $500,000 per year. I'm liable for a 3% interest rate only, so that's $15,000 instead of needing to dish out a $500,000 premium payment. Now, each year, whatever my total loan balance is, the loan, that's what I'm liable to pay interest on. So kind of like that last example. If I'm borrowing out $500K per year, just to stay on the same track here, at 3%, year one, that's 15K. Year two, the total loan balance now would be $1 million. 3% is 30K that the company has to dish out of pocket. So that will increase the out of pocket via loan interest each year. And then eventually, typically how these are modeled is one plans to use the cash value to satisfy the loan, clear it altogether. Let's take a look at an example here. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.